Most people run from debt, but the wealthy, they run toward it and they use it to multiply their fortunes. Today, we're breaking down how debt, used the right way, can be a wealth accelerator, not a trap. I'm going to show you how smart borrowing strategies like leveraging assets, margin accounts, arbitrage, and inflation are used by the wealthy to scale their fortunes, and how you can use the same principles in your wealth strategy. Let's get into it. Most people think about debt emotionally. It feels like stress, risk, or failure, but the wealthy see it differently. To them, debt is a tool. It's leverage, which allows them to access opportunities without liquidating their best assets. The key difference, though, is that they borrow strategically with a clear eye on return on investment. There's good debt, like funding a real estate purchase that builds cash flow, and then there's bad debt, like borrowing to buy things that lose value or don't generate income. The wealthy borrow to buy assets, not liabilities. Take Rockefeller. He borrowed $1,000 to launch his first business, and later borrowed more to acquire competitors to consolidate the oil industry. He wasn't spending, he was building, and that's the point. Debt can absolutely create wealth if it's used to acquire assets that work harder than the interest owed. Now let's talk arbitrage. This is when you borrow money at a lower rate and invest it in something that yields more. If you can borrow at 4% and invest at 10%, you're not just leveraging capital, you're creating spread. And that spread is profit to the owner on borrowed dollars. This is what Elon Musk does when he borrows against Tesla shares instead of selling them. It keeps him liquid, avoids taxes, and allows the stock to continue compounding. But here's where it gets practical, because you can do this too, even without billions. Margin accounts are one of the most underused tools for individual investors. If you have a taxable investment account, many brokerage platforms allow you to borrow against your own portfolio. This is called a margin loan. It's not for buying more stock on leverage. It's about accessing liquidity without triggering a sale or taxes. Here's an example. Let's say you have a $500,000 investment account and you want to access $100,000 at 6% interest. You could use that for a business investment, a real estate deal, or to bridge short-term needs without having to sell a single share. It's your own personal credit line backed by appreciating assets. Margin accounts amplify both upside and downside, so you must use it carefully. But if used responsibly, it could mimic the exact strategies that billionaires use. Real estate makes the math even easier. You put 20% down, the bank covers the rest. Renters pay for the loan, and the assets appreciate. And tax laws let you write off depreciation, even if you're still collecting income. It's the most practical, tangible version of leverage, and it works at every income level. Even Mark Zuckerberg took a mortgage instead of paying cash because he'd rather invest that capital elsewhere while inflation erodes the real value of that loan. Debt in real estate isn't a burden, it's a multiplier. Now here's the mindset shift. The wealthy don't sell their best assets to get cash. They borrow against them. And that's what margin lets you do with your portfolio. If you're holding long-term stock positions, you don't have to sell them. A margin loan might allow you to borrow against your portfolio and keep it working for you, all while getting the liquidity you need. And if inflation is 3% and your fixed rate debt is 2.5%, well, your repayments actually get cheaper in real terms over time. Meanwhile, your assets, whether it's real estate or your portfolio, should grow with or exceed inflation over time. That's why the wealthy lock in long-term, low-interest debt, because over time, inflation repays part of the loan for them. Mark Zuckerberg's mortgage interest rate becomes more relevant every year, while his investments continue to grow. So what have we learned? Debt isn't the enemy. Misuse of it is. The wealthy use debt as a tool for liquidity, leverage, and tax strategy, whether it's through real estate, stock-backed loans, or margin accounts. And you don't have to be a billionaire to use these strategies. If you're earning well, managing investments, and thinking long-term, you can absolutely start putting these ideas to work. If you're ready to apply these principles to your financial strategy, subscribe to our free newsletter at makingsenseofyourmoney.com. Debt doesn't have to be dangerous. It just has to be deliberate.